Hey everyone, this is Michael St. Clair with Freedom Equity Group, and today we're going to be talking about the Guarantee Plus 2, or as many of us know it as, the GUL with American General Partners Group. Now, once you log into the eStation, you're going to want to slide all the way down here to the bottom left. You're going to click on the WinFlex, Start or View Your Cases, and then the WinFlex dashboard will open up for you, and we're going to go to Illustrations. And we would like to start a new case. We're going to select QOL and then the Guarantee Plus 2. Go ahead and click Create Client. Client's name, we'll say Valued Client today. And he will be a male, 45 years young. And we'll go ahead and give him a preferred non-tobacco rating. We'll use the state of Texas. Come up here to the software tab, and we're going to have a few software options. In this case, we're going to solve for premium. We know how much face amount the client would like, and guarantee to age. With the GUL2, what I love about it is the client gets to pick how long they want the coverage. So they could have it all the way out to 121, they could have it to 95, 90, 82, 92, it really doesn't make a difference, but it's in the client's hands to choose. So in this case, we're going to say the client wants to go to the age of 100. Go ahead and enter 100 there. And we're going to use $250,000 as the face amount. And years to pay, our premium, we got 3 selections, year, age, or max. We're going to go ahead and select max first. This means the client is going to pay till the age of 100. Disbursements, there's not going to be any disbursements on this policy. Policy options, the death benefit is only level when it is a GUL. And the premium payment mode, we're going to come down here and we're going to select monthly. And if you had any 1035 exchange money coming in, you would enter it in the appropriate boxes here. Discounts, this is where we would do the laddering or add the QOL advantage. Adding up to 5 additional term policies onto the base policy of the GUL. But in this case, we're going to keep it basic and simple and just focus on the GUL2 and the power of it. It's like perma-term, but the client's guaranteed to have coverage when they need it most. Riders, like normal, the ABRs are standard across every policy and they are free. Another thing I do like about it, it is called the ROP enhancement, and what that actually does is this gives the client the opportunity 2 times throughout the policy's lifetime to actually get some of their premiums or all of their premiums back, and we'll discuss that once we see the illustration. And the agent info, we're going to go ahead and select the correct state, Texas. And we're not going to have to do anything on the access or concept. So that's the basic illustration how to run a GUL quote. Very, very easy, very simple, similar to doing a term quote. So while we're waiting for this to populate, the GUL is great. It goes up to $2 million of ABRs, and then you could also add what's called the AAS, or the Accelerated Access Solutions, which would give you up to $3 million of chronic illness claims that you could potentially have. And the best part about it is the client knows exactly what they would get dollar for dollar. So, but we're not going to get into that in this segment. That will be in another segment. So now that we have the illustration up here, we're going to go ahead and click on illustration, the little PDF icon. And our monthly premium is coming in at $179.72. So let's scroll on down here and make sure the coverage is lasting till the age of 100, like planned. All right, so our annual premium is $21.57, starting in here at pretty much at age 45, but insurance age 46 always, because we're always a year next on the illustration. And getting into that ROP we talked about, or that return of premium enhancement that is free on every policy, you're going to notice you have 2 different options during that policy lifetime. One coming on the 20th anniversary date. So the client at that point in time would have the ability to take up to 40% of the death benefit or less, but never more than 50% of total premiums spent. Now, if they were to take out that $21,566, the death benefit then would reduce by about half. Now, the client has up to 60 days from the 20th policy anniversary date to access those funds. After that, they will have to wait till the following option, which comes in year 25. And then at that point in time, they have the ability to take out 100% of their premiums, which would be $53,916. But we're going to continue on down here and make sure the coverage goes all the way out to 100 like it should. Now, let's take note of one thing. Our client's paying essentially $120,772 over their lifetime if they were to live to 100 or 101. So I want everybody right now, take your pen out, write that down. Make sure you wrote down the $179.72. That is the monthly cost for the premiums for the policy. Now, we're going to look at what we could do to pay this policy off earlier. What if your client could have the coverage paid off before they entered retirement? Because during these years, 70 and on, the client may be restricted to a certain amount of income. And right now they're in their working years. So if we could eliminate these premiums while they're working and pay it off sooner but have guaranteed coverage for the rest of their life at an affordable price, do you think that they would like that? So let's take a look and see how we do that. We're going to assume our client's on a $250 budget, we'll say, and we're going to come back to solve for. And we're going to go to the years and age to pay premium, and we're going to simply select age. And we're going to enter 69, pay it off by the time we're 70 years old. And we're going to come back up here to the top right and add calculate. Now, a lot of times the GUL is great for baby boomers. It's great for somebody that is younger, maybe in their 30s, because the term may not last long enough for them. I use it for income protection for IUL sales and clients for the agents. There's many different reasons why you could use a guaranteed universal life product. It is the #1 universal life product sold in the United States every year. So let's take a look at how much premium increased just by paying it off 30 years sooner. So come down here to the second page, and our new premium is now $249.90. Now, we stepped up about $70.18 roughly, but this is during their working years. So if that $70 is perfectly fine with them and they can afford that without really stretching funds too much, and remember, they were on a $250 a month budget, so we stayed underneath that. But I think they're going to like what you're going to show them here in just a moment. So we're going to come down here to the illustration pages in just one moment. All right. So now we're paying $29.99 every year, and we're going to stop paying this at age 70. So we're going to pay it through 69, stop at age 70. But now look what we have done for the client. The coverage now has only cost our client $71,971. That's a difference of $48,801 during their retirement years. Do you think that would matter for a client? Do you think that could help them out a little bit? But the best part about it all is this. Their coverage is guaranteed till the age of 100. As long as they have not filed a claim or anything like that, their coverage is going to be enforced when they need it most. And that is the beauty of the GUL, not to mention the fantastic ABRs, but the ability to pay it off sooner. Give the clients flexibility. If we can minimize their bills into retirement, we should. But once again, it may not work for everybody due to premium increase, but it's always great to go over it with your client. Now, before we end, we're going to run one more situation or scenario, and we're going to add the laddering or the QOL advantage. Let's say my client needed $500,000 of total coverage. Not a problem. So they said they could increase their budget a little bit. So what we're going to do, we're going to keep this paid off by 70. And we're going to come over here to the discounts tab, and we're going to select these three boxes. And when you select the QOL advantage, once again, it is a QOL advantage and not a term rider. So make sure when you talk to AIG and when you talk to your clients, you let them know that it is the QOL advantage and not the term rider. We're going to select preferred as the underwriting class, and we'll do $150,000 for 15 years. And then we'll do $100,000 for, let's say, 25 years. So giving us another additional coverage of $250,000. Now the benefit of this is going to be they're going to get a discount. Whether they were to buy these policies standalone, it would cost them more. But because we're bundling them together on a volume basis, we're actually going to save them money. So once you have that inputted, come back over here, hit calculate. Now there are some other great features with the GUL2, the lifestyle income solutions and the combo with the AAS, but we're going to get into that in more the second series of our AIG training videos. This is the second part of a three-part series. The first part we did was the term and the term laddering. This one will be the GUL2, and the next one will be the max accumulator plus IUL. So now that we added the QOL advantage, the two additional term policies, which will act as separate policies and come with the same traditional ABRs free of charge for our client, our premiums aren't going to change for the GUL. However, when we're going to scroll all the way down here to the bottom, and we're going to go to this page right here. All right. So for the first $150,000, and that's the 15-year term, if they were to buy the policy standalone, it would have cost them about $26.47. Now, we're going to give them a discount of $13.49, leaving their new premium for this policy at $12.98. Then for the $100,000 for 25 years, it would have cost them roughly about $32. However, the QOL Advantage discount kicks in, saving them $14.71. The new premium is $17.30 for that policy. Total combined premium, and it is only one premium because it is combined, is $280.18. We've saved the client $28.20 a month. That's an average of about $338 a year. Now, why would we add the QOL Advantage? Meeting specific needs. Maybe they want to make sure the kids are through school. Maybe they want to make sure their mortgage is paid off. Whatever the reason may be, we could add up to 5 of those term riders attached in the QOL Advantage to alleviate those concerns. So I want to thank everybody for spending time with us today, and be on the lookout for the third part of this series, the Max Accumulator Plus IUL, how to show your client the power of a tax-free retirement, the true living benefits. Thanks everybody, and have a wonderful day. Bye-bye.